Picture your first $10,000. It's sitting right there in your bank account, and you think, congratulations, you made it. But what you don't realize is that this moment isn't the finish line. It's actually the starting line of a completely different game. And if you don't understand what changes after your first 10,000, you're about to make some expensive mistakes that will keep you broke for years. I've been studying wealth building for over a decade, and I've noticed something fascinating. There's a psychological and financial shift that happens at exactly $10,000 that separates people who build real wealth from those who stay stuck in the paycheck to paycheck cycle forever. And most people have no idea this shift even exists. The first thing that changes is your relationship with money itself. Before 10,000, every dollar feels precious. You count every penny, you track every expense, and you feel genuine pain when you spend money. This is actually good behavior, but it creates a scarcity mindset that can trap you if you don't evolve past it. Once you hit 10,000, something weird happens in your brain. That cushion makes you feel rich even though you're not. You start making small splurges that don't feel significant individually, but they compound into wealth-destroying habits. A $50 dinner here, a $100 gadget there. Suddenly your 10,000 starts shrinking and you can't figure out why. But here's the real kicker. The people who understand this transition use it as a springboard. They recognize that 10,000 isn't wealth, it's leverage. It's your first real tool for building actual wealth, but only if you treat it correctly. The second major shift is in your investment options. Before 10,000, you're essentially limited to basic index funds and maybe some individual stocks if you're feeling adventurous. Your broker treats you like a beginner because, frankly, you are one. You're playing in the kiddie pool of finance. But 10,000 opens doors that were previously locked. Real estate investment trusts, dividend-focused portfolios, peer-to-peer lending platforms, and even some alternative investments become accessible. More importantly, you can start thinking about real estate investing, which is where many millionaires actually build their wealth. Here's something most financial advisors won't tell you, because they profit from keeping you in mutual funds. $10,000 can be the down payment on your first investment property in many markets. While your friends are celebrating their emergency fund, you could be leveraging that money into an asset that pays you monthly and appreciates over time. The third transformation is psychological, and it's the most dangerous one. I call it the comfort trap. When you have 10,000 in the bank, you feel secure enough to stop being aggressive about making more money. You've proven you can save, so you relax. You stop looking for side hustles, you become comfortable in your job, and you stop pushing yourself financially. This is exactly backwards. 10,000 should make you more aggressive, not less. It should be proof that you can accumulate capital, which means you should immediately start working on your next 10,000, but with better strategies and more sophisticated approaches. The fourth change is how you start thinking about time. Before 10,000, you think in terms of monthly budgets and annual goals. After 10,000, you should start thinking in decades. You now have enough money that compound interest becomes a real factor in your wealth building, but only if you give it time to work. Albert Einstein allegedly called compound interest the eighth wonder of the world, and with $10,000, you can finally start experiencing why. But here's the catch. Most people take their 10,000 and immediately start thinking about what they can buy with it, instead of thinking about what it could become over 20 years. If you invest $10,000 in a diversified portfolio returning 7% annually, which is conservative based on historical market performance, you're looking at over $70,000 in 30 years without adding another penny. But if you add just $200 monthly to that same investment, you're looking at over $600,000. The fifth shift is in your social circle and the way people treat you. Friends and family start coming to you for financial advice, even though $10,000 doesn't make you a financial expert. They start asking for loans, they start assuming you can pick up checks, and they start treating you differently. This social pressure can destroy your wealth faster than any bad investment. I've seen people blow through their savings simply because they couldn't say no to social expectations. You need to develop boundaries around your money, And you need to understand that lending money to friends and family is usually just giving money away with extra relationship drama attached. The sixth transformation is access to better financial services. Banks start treating you differently when you have real money in your accounts. You qualify for better credit cards, lower interest rates, and premium banking services that can actually save you money over time. But more importantly, you can start building relationships with financial professionals who can actually help you grow wealth instead of just managing your checking account. Fee-only financial advisors, real estate agents who work with investors, and tax professionals who understand wealth-building strategies all become accessible and worthwhile at this level. The seventh change is your ability to take calculated risks. Before 10,000, any financial risk feels like it could wipe you out completely. After 10,000, you can afford to put smaller amounts into higher risk, higher reward investments without jeopardizing your basic security. This is where many people either accelerate their wealth building or plateau forever. Conservative investors keep everything in safe investments and build wealth slowly. Aggressive investors put it all in risky bets and often lose everything. The smart play is somewhere in between. Consider keeping 6 months of expenses in high-yield savings as your true emergency fund, then treating anything above that as investment capital. This way you maintain security while still being able to pursue growth opportunities. The eighth shift is in your understanding of debt. Before 10,000, all debt feels scary and overwhelming. After 10,000, you can start understanding the difference between good debt and bad debt, and you have the resources to strategically use leverage to build wealth faster. Good debt helps you acquire assets that appreciate or generate income. Bad debt pays for consumption that loses value immediately. A mortgage on a rental property is good debt. A credit card balance from vacation spending is bad debt. The final transformation is the most important one. After your first 10,000, you prove to yourself that building wealth is possible. You move from hoping you might become financially secure someday to knowing you can make it happen. This confidence change is what separates people who build real wealth from those who stay stuck forever. But confidence without strategy is dangerous. Your first 10,000 should teach you that saving money is just step one. The real game is learning how to make your money work harder than you do, and that requires education, patience, and smart decision-making. So if you're approaching $10,000 or you just hit it, congratulations. But remember, this isn't the end of your financial journey. It's the beginning of the real game. What you do with this milestone will determine whether you join the ranks of the truly wealthy or stay stuck celebrating small wins while missing the bigger opportunity. Your next goal isn't 20,000, it's using your first 10,000. So effectively that your second 10,000 happens faster than your first. That's how real wealth gets built, and that's how everything changes after your first $10,000.